Alright, so welcome to this video on part 2 of how to decode new uptrends for huge profits. So in part 1 of the video, I showed you how I use moving averages to identify a change in trend. So for example, on a downtrend, you notice that the 50 moving average, which is the blue line, is always below the 150 moving average, and they are always sloping down when it's on a downtrend. So once again, you can see on Microsoft, this is a downtrend, obviously. A downtrend is defined as a pattern of lower highs and lower lows. So on a downtrend, you've got wave down, wave up, wave down, wave up, wave down, wave up, wave down. So it makes lower highs and lower lows. And on a downtrend, it's pretty clear when you look at the blue line, 50 moving average, and green line, 150 moving average. They are both sloping down, as you can see, and the blue line is always below the green line. So how do you identify from a downtrend to an uptrend? Two conditions must be met, as I talked about in the first video. The first condition is both moving averages have to stop sloping down. They have to flatten or slope upwards. And the 50, which is the blue line, has to cross above the green line, the 150. Only when the two conditions are met do we have a confirmed change in trend. So in the case of Microsoft, you can see from a downtrend, it reversed into an uptrend right here. When the blue line crossed above the green line and they started changing slope, right? So over here at the crossover, the blue is sloping up, the green flattened. So right here, this is the confirmation of the change in trend. So that is when it's so-called the safest point to enter to catch the new uptrend. And yes, we don't get to buy right at the bottom. In fact, if you want to buy near the bottom, there's a different technique I use called the slingshot technique, which I teach in my trading courses, and I also talk about it in my investing courses. But in this video, we're just going to talk about catching trend confirmations, right? And you get in over there at the change of the Microsoft trend, you get a pretty good run. And currently you can see Microsoft is still on an uptrend. And on an uptrend, again, prices don't go up in a straight line. They still go through the wave up, wave down, wave up, wave down, wave up, wave down, wave up, wave down, wave up pattern. The trend will continue until the trend ends. When it ends, no one knows. As long as the trend is there, we ride the trend all the way to the end. Okay, so in part 2 of this video, I'll be showing you another method to identify a change in trend. And first of all, I did not invent this method. I'm not that smart. I learned this method from this person called Victor Sperandio, almost 30 years ago. And Victor Sperandio, by the way, is known as one of the legendary traders from Wall Street, so I got to give him credit. And I first learned about price action and moving averages from this book that he wrote. This book was written 33 years ago. It's called Methods of a Wall Street Master. And I read this book back in 1998. So that is, almost 30 years ago. And I can tell you that a lot of his techniques about price action and moving averages has influenced a lot of my techniques over the years. And I would say that he's one of the best market technicians there is in the world. All right. And I'm not sure if he's still trading or he's retired. I'm not sure. But great book to actually read. Okay. So this method actually, or something I learned from Sperandio years ago. So this method basically, first of all, again, a downtrend is defined as, again, a pattern of lower highs and lower lows, right? So it looks something like this, a downtrend. Let me just draw it out. Okay, so this is kind of like a downtrend, something like that, okay? And one of the things that we want to do when we see a downtrend is to, first of all, draw the downtrend resistance, And there's a specific way to draw it. And the way to draw it is you always connect, well, first of all, you identify the lowest low of the trend, right? So this is called the lowest low of the trend. It's the lowest point in the trend. And then you identify the high just before that low, right? So the high could be this, it could be this, it could be this. One of the highs before the lows, and you connect that high to the highest high of the of the downtrend, in a way that it doesn't touch any other points. In other words, it should be a line connecting 2 points, and it doesn't intersect any other part of the trend. So the way you would draw a downtrend, according to Victor Sperandio, and it's the way I've learned over the years, is to connect this line, for example, this point to this point over there. So that would be the trend line. Okay, so again, you connect the highest high of the downtrend to the highest high preceding the lowest low in a way that doesn't intersect any other points. If it intersects any other point, it's not a valid downtrend. So that's the first thing to bear in mind, right? Now, so as long as the price, the black line is the price, as long as it remains below this blue line, that means the downtrend prevails, okay? So how do you know the downtrend is broken? And how do we know it is the start of a new uptrend? So a few things have to happen. Number one, the first thing that must happen is the price has to break this downtrend resistance. So the price has to eventually, boom, break this downtrend. Now, there are traders out there, especially amateurs, where the moment the price breaks out of the trend line, they start to buy over there. And that's pretty risky because you get a lot of fake outs. So a fake out is when the price breaks above the trend line. You thought, okay, the trend line is broken, it's a new uptrend, and you buy there, and the next thing you know is the price falls back down into the trend line. Very, very common. So don't ever buy the first break of the trend line. You get a lot of fake outs. So what you want to do is wait for the break of the trend line, and as the price goes up, it will make a high somewhere, all right? And then it would pull back. Now, does it always make a high and pull back? Not always. Sometimes the price will just keep flying all the way, and well, there's nothing you can do about it. Then you can't use this method. Then you have to use the moving average method to catch the uptrend, okay? So in this method, you have to wait for the price to pull back from this high over there. Let's call this point A, all right? Now, when it pulls back, you want to make sure that it doesn't go lower than this low. If it goes lower than this low, that means the downtrend continues, right? So it has to form a low higher than this low. So let's call that point B, yeah? And then the next thing you got to do is you have to wait for the price to break above point A. And ideally, you want it to break above point A with a bullish candle. And that, my friends, is the entry point. That is the safest point to enter in order to confirm the new uptrend signal. Right? Now, again, with everything in technical analysis, there are no guarantees. It does not mean that it would definitely go up. Could it still reverse back down? Of course. So in trading, it's not 100%. Right? In trading, no matter what technical methods you use, your best win rate would be about 60%. So expect out of 100 trades, 60 winners, but you will get 40 losers. And that's why you have to put a stop loss so that when you lose a small percentage of your capital, but when you win a lot more than when you lose. And that is how you generate consistent profits as a trader, right? It's playing the probabilities. So where do we put the stop loss? All right, so we know we enter right here, right? So there are two places to place the stop loss. One place to put the stop loss would be at the most recent swing low, which would be over there, right? Stop loss there. And if you buy here and you place a stop loss here, this is what we call your risk, your 1R risk. For example, if you're buying at $50 and your stop loss is at $40, what's your 1R risk? Your 1R risk would be $10. This is the risk per share that you're buying, right? So if you're risking 1R per trade, you want to make sure that you're making at least 2R or more in profit before you exit, all right? So in other words, your profit target has got to be at least, ideally, 2R, which in this case 2R would be multiplied by 2, $20. So your profit target has to be 50 bucks plus 20 bucks, at least $70 to take profit. All right. So again, the whole idea in trading is that if you take 100 trades based on a technical setup, you can't win all. But if you could win 60 trades and you lose 40 trades, right? But each time you lose, you're losing 1R, right? So you're losing 40 times 1R. And each time you win, you're winning 2R, multiplied by 2R. So if you do that, you're getting 120R over here, and you're losing 40R over here. So net, you're making 80R. Now, the important thing is you need to size your position in such a way that each time you enter a trade, you're only risking 1% of your capital. Now, if you're not sure how to position size your trades, how many shares to buy, please watch my video on position sizing, where I teach you the exact formula to calculate the number of shares to buy and then to sell, right? So if you are risking 1% per trade, that means in 80R, you're getting an 80% return on your capital with just a 60% win rate. So the great thing about trading is you don't need a 90% or 100% win rate to make a good profit. If you can just get a 60% win rate consistently, but you have a good risk to return ratio where you're risking 1R to make 2R or more, you're going to do really well in the markets. So let's apply what we just learned to our charts. Let's go back to the Microsoft chart and let's see how we could have used this trend break technique. Okay, so over here you can see Microsoft is on a downtrend, and the first thing to do is when you see that downtrend, you want to identify the trend line. So where do I draw the trend line? So the first thing would be to identify, first of all, where's the lowest point of the trend, which happens to be here. That's the lowest point of the trend. So you want to take the highest point preceding the lowest low and connect it to the highest high without touching any points in between. So the highest high would be somewhere here, and you want to connect this to here. Now you couldn't connect it to here because then it would cut other points. So this is not a valid trend line. It cannot cut any other points. So the only reasonable line would be this line over here. So I'm just going to draw that in. There. That would be our trend line. All right. So where was the trend line broken? Here, you can see this was the break of the trend line. And like I said, a lot of amateurs, once they see the break of the trend line, they think, hey, it's a new uptrend. They buy there. And what happens after they buy there? They maybe put a stop loss below that, and then the price comes down, hits their stop loss, and they get stopped out. And after they get stopped out, the price runs and they go, ah! Right? Very common. That's a fake out technique that market makers use to shake out the weak holders, to take out the stop losses, and they then run the price up. So you don't want to get in on that first break of the trend line. Very prone to false breakouts. So once that price breaks, then it starts to pull back, which I mentioned earlier on. So you want to draw a line at this new high that we have identified, right? So I'm going to draw a line at that new high. There we are, at 276. And then it pulls back. Now when it pulls back, you want to make sure it doesn't go below that swing low. If it goes below that swing low, game over, the downtrend continues, right? So in this case, it goes all the way down here, and then it reverses back up, making a higher low than this low. In fact, this low is also higher than this low. So in a way, it's really making higher lows. That is already an indication that this new uptrend is beginning to form, all right? But we can't just have higher lows. We need higher highs, okay? So we want to make sure that the price breaks this point A in order to confirm the new uptrend. So where does it break point A? Right here, this candle over here. That is the first bullish candle to break point A. And that, my friends, is the entry point. That's the buy entry point right there. Okay? And interestingly enough, it kind of like coincides with the 50-150 moving average signal, doesn't it? Right? So based on the 50-150 signal, the blue is sloping up, the green is flattening, the blue crosses the green, and based on the moving averages, we also enter at that point. Okay? So it's really cool. So whether you're using moving averages or you're using this trend line break, you'll get a very similar entry point, which is basically the point where the new uptrend is confirmed. Now, again, it all depends. If you're entering Microsoft as an investor and you're holding it for the long run, then of course you don't place a stop loss. You just buy over here, right? In fact, I can tell you that personally, as when I invest in stocks, I don't wait for a new uptrend to buy. I'll buy a lot earlier, even near the lows over here, using another technique called the slingshot method, which again, I teach in my courses, right? But if I'm entering it as a trade and not an investment, you know, a trade is more like a date rather than a marriage, right? Then I'll put a stop loss. And if I'm entering there, I'll put a stop loss at the most recent swing low. So I'll put my stop loss somewhere there. So it's a pretty wide stop, as you can see. So this is a pretty big, pretty much of a medium-term trade that we're taking, right? So I'll put my stop loss here. And when I get in, I'll then let the trade run. And again, there are a few ways to take profit. One way to take profit is once you hit that 2-hour target, then you just get out. And another way is you just stay in the trade with no profit target, and you only exit the trade when the uptrend reverses down into a new downtrend, which has not yet happened for Microsoft. So you can see that if you got in over there, you would have caught this uptrend all the way up. And right now at 420, the uptrend is still there. It has not reversed to a new downtrend yet. And when will that happen? No one can predict that. We can't predict when the trend will change. We can't predict how long the trend will last. All we can do is to identify when the trend changes. Right? So that's Microsoft. Let's take a look at a few more examples. How about Salesforce? Let's apply what we learned to Salesforce. And as you can see, I've already drawn the trend line based on the rules I talked about earlier on. So that's the trend line I've drawn. All right. And where was the break of the trend line? Right here. So you can see this was the break of the trend line. Okay. And again, it's dangerous to buy that initial break. It could be a fake out. In this case, it wasn't a fake out, but you never know, right? So once it breaks, we're waiting for it to run to make a new high. So again, let's call that point A. Then it pulls back to make a new low, call that point B. And this low cannot be lower than this low, which it isn't. It's a higher low, right? And then we're waiting for the price to then break above point A. Now in this case, you can see that it gapped above point A. Now if it gaps above point A, I wouldn't get in. All right, especially if it's a bearish candle. You can see it came back down again, right? And then it closed above point A with a bullish candle. That would be a safer entry to buy. That would be the safer entry to catch this new uptrend in Salesforce. And where could you put the stop loss? You could put it at the most recent low here, or you could put it below this gap over here as well, because a gap represents a pretty strong level of support and resistance. So again, if you're more aggressive, stop loss over there. If you want to be a bit more conservative, stop loss below that swing low, and you would have caught that very nice trend in Salesforce. And Salesforce continues to be on an uptrend. Now over here, you can see the 50 crossing below the 150. Is this a downtrend signal? No, because you can see the 150, the green line is still sloping up. So that is not a downtrend signal. We are still on a nice uptrend for Salesforce. One more example, let's take a look at ServiceNow. Make sure you guys get familiar with this technique. Okay, there we are. Service now. There's our downtrend. That's the trend line. That's the break of the trend line. As you can see, breaks the trend line, goes up. That's point A, right? Pulls back. That's point B, and B is higher than the swing low. It's making higher lows, and then we're waiting for a break of point A. There we are. That's the break of point A, and that is the entry. That's the buy entry when the uptrend is confirmed, right? And right now you can see if you got in there, you would have ridden that uptrend all the way up, and we are still on this uptrend on service now. How about Google? Let's look at Google. All right, there we are. And again, notice you could have used the moving averages as well. You can use either the moving averages, the 5150, or the trend line break, or either or. All right. Again, Google, you can see that's a trend line. That's the break of the trend line. Break of the trend line. That's the high, the point A, goes down to point B, and then closes above point A over there. So this would have been a buy. This would be the entry point. Stop loss would be this swing low there. The most recent swing low. That would be the 1 hour distance, the risk they are taking. And that would have caught that trend up there. So this would have been quite a number of hours. We have gotten already, 1, 2, more than 2 hours in fact. Yeah, we are all the way up here. Probably 3 or 4 hours. Okay. Finally, let's go back and look at PayPal. I talked about PayPal in the last video, showing you the moving average crossover. But could we have used this trend line break technique? Yeah, absolutely. That we have got a very nice trend line on PayPal. You can see it was on this very nice downtrend. And over here, you can see it broke that downtrend resistance. We had a lot of amateurs buying there and then getting stopped out, getting faked out, right? And then it broke again, broke it again over here. And then, by the way, so this is the point A. This is point A. And after point A, it's gone down. This is point B. It's made a higher low than the swing low. So it's a higher low and a higher low over there. But it has to break point A. It has to close above point A to confirm the uptrend based on the trend line break technique, right? It has not yet done that. It has not broken it yet, right? So only when it breaks and closes above 68, then it'll be a confirmed change in trend based on the trend line break technique. However, based on the moving average technique, it actually has confirmed the uptrend already, right? Because again, the 50 is above the 150, sloping up. So that has actually confirmed it. So you could use either technique, whichever comes first. So I do hope you found this technical method useful. It's a very simple method, but it's a pretty reliable method as well. And one of the many techniques that I use to trade as well as invest in the different financial markets. Thanks for watching, and may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.